Hi everyone, Natu here, back with another video. And I'm going to quickly walk through the ins and outs of using a Regulation D 506C exemption versus Regulation D 506B exemption to raise capital. Yeah, so in the United States of America, just keeping everything really high level, you have different exemptions. So an exemption just means when somebody is selling an investment to people who are they're selling an investment to people. The thing is, like, back in the Great Depression days, people got in trouble by selling deals to people who weren't sophisticated enough to understand what these deals were. And a lot of people lost a lot of money. And think about how much of your life is spent making money, and imagine losing all of that by making one bad decision. So this is why you have different regulatory bodies and different nations rise up. And so in America, it's the Securities and Exchange Commission. In Canada, it's the Canadian Securities Administrators. In Australia has one. The UK has this set up. Every Commonwealth country and even developing countries, everything, they all have their own versions of this. And the United States, the most common one you see is the regulation, or I guess, by registering, this means setting up to actually raise capital by selling your securities on the public exchange. So everyone can go and buy Apple stock, but only a certain few amount of people can go and buy, the stock in the latest startup. And the reason why that's the case is because the regulation is there to protect people from making investments into something that they don't have enough money to invest in, they're not sophisticated enough to invest in, or they can't afford to lose that investment in. It also prevents people from benefiting from the upside of these investments. But then, all that aside, there's one of the number one most popular exemptions, which exempts somebody from registering the securities on a public exchange, meaning that you can just sell the securities without having to register on an exchange. This is why they call them exemptions. One of the most popular ones is the Regulation D 506C. And so the Regulation D 506C, what this means is, and what this allows somebody to do, is to raise capital from accredited investors. And so accredited investors, by the definition at the time of this recording, there are several definitions for accredited investors. One of them is that they have to make over a certain amount, whether you include their spouse or not, they have to make a certain amount per year. And the amount that they make determines whether the person's accredited or not. And there are different factors as well. For example, some people who are a registered exempt market dealer or registered, via FINRA and so on, may count as an accredited investor. Somebody who is, and there are different exemptions that somebody can walk through. And a way to find out is to look at the subscription agreements. But then when it comes to the 506B, they're allowed, at the time of this recording, people are allowed to solicit accredited investors, and then to also solicit non-accredited investors, to work with non-accredited investors, the limit up to 35. And because some of these investors will be non-accredited, there'll be additional work needed to vet and validate some of these investors to make sure that they're suitable for the investment. Because if an investor who is quote unquote, unsuitable for the investment invests, for example, they may be unaccredited, but they're not sophisticated enough and they don't understand the type of investment that they're getting, then you may fall subject to a lot of serious problems when it comes to lawsuits, and the Securities and Exchange Commission likely wouldn't be on your side, right? So, that's one huge difference. Another huge potential difference is there are a lot of cases, there may be cases and situations where there's something called the private placement memorandum, which is a summary. It's almost like a business plan. It's like the summary of all of the, you include a lot of risks about the investments, the business strategy, the investment strategy. Basically, it's a well-defined argument that talks about the benefits of the investment, how the investment works, and some of the risks when it comes to investing. And this is typically done, in explaining what the nature of the offering, the shares, and everything. The plans to go public. It's usually like a 75-page document. And this document accompanies something called the subscription agreements, which may be a separate document or maybe the same document. And the subscription agreement is the legal agreement that investors sign when they wire the money to whatever either escrow account or place that the investor is getting the investment. So, typically another big difference is that in many cases, this is not legal advice, but in many cases, there are situations where the PPM is more required for the 506C rather than it being required for the 506B. Now, nobody should ever try to escape doing a private placement memorandum, but sometimes that is the case. And then people would tend to, these situations usually happen in the 506B. Due to the way that, due to some of the exemptions that go on and the fact that there is some investor vetting ahead of time, right? And so those are two massive differences between the 506C and the 506B. And I guess the final one is that the 506C is way more common, it's the most common exemption, generally speaking. It allows people to raise an unlimited amount of capital. And so because it's common and it allows people to raise an unlimited amount of capital, broadly speaking, it has the unique benefit of having the biggest amount of people that can assist with setting that up from a legal perspective, from an accounting perspective, if it makes sense to really, but more from a legal perspective and from a consulting perspective. Many real estate syndicators, for example, are aware of this structure. And if people are looking to work with only large check investors and they want to get something going quick, the 506C is the quickest route, broadly speaking. And so with all these things, I hope this brings some quick insight about the 506C versus the 506B and just some of the in and outs as to why people prefer one over the other. But if this video just whets your appetite a bit, what do I do? What does Raises.com do? Well, we help people raise capital by assisting them in the preparation and the execution of the deal. And if you want to learn more, just head to Raises.com and we'll potentially see you there.